So what the heck is a HECM? HECM stands for Home Equity Conversion Mortgage, and it's the new form of reverse mortgage. So I'm going to get a little bit more into it. I told you guys in my commercial the basics of how it works. It's a very, very easy concept to understand when I put it that way, but there's a lot more to it that we're going to go through. So first of all, who is Phil? And Eric very eloquently said a lot of this for me. I do have degrees in international relations, economics, and geography. Economics helps a lot in the mortgage industry. A lot of people think when you hear that the Fed is going to increase the interest rates, that the Fed has any control of interest rates. They actually have no control of the interest rates. They control the money supply. So by increasing or decreasing the money supply, they in effect control the interest rates. So there's little things like that that I understand in the background of my business that help me with my clients as well as with the people that work with me. I'm a veteran. The first reverse mortgage I ever wrote was in 2008 for my grandparents. So when I was looking at it from the point of view of an heir. I wasn't looking at this as something that I was selling to people and an opportunity to sell. I was looking at it from my own family. My mom had already passed away, so I was their direct heir. And I really dug in to understand how it works. And in the end, I said, why is there so much negativity? Why are there so many misconceptions about the reverse mortgage? So after doing that one, I joined a company that was starting with the reverse mortgage, and I've gone to big lenders. I was with MetLife and Genworth. When they did reverse mortgages, they got out because of all the new compliance stuff, the Dodd-Frank Act. And I opened my company in 2012. Certified reverse mortgage professional. There's very few. When I got my certification in 2013, there were only 66 in the whole country. So there's very few people that understand and go through the testing and classes needed to get this certification nationwide. NMLS Ethics Committee, so I uphold the ethics, the ethical values of our industry for myself and my company, but also for the rest of the country. Came out in Forbes a couple years ago. I'm a panelist last year on to rewrite the national mortgage test. So every mortgage broker in the country, every person at a lender that gets their NMLS license takes that test, and I was part of a panel to rewrite that test as an expert in reverse mortgages. As Eric said, I'm the owner of the #1 reverse mortgage company in Florida, 2015, 2016, and this year as well. And I've closed hundreds of reverse mortgages. So you hear me say, who is Phil? But if you see on my business cards, it also says Felipe. So who is Felipe? Felipe is not my name by any means. My name is Phil Stevenson, but my mom is Cuban. My dad is from South Carolina. I do speak fluent Spanish. So I do have a joke that I don't want anybody to be offended by. So I usually say that I'm a Cuban Cracker from the Cuban. And the cracker, sometimes cracker can be seen as a negative thing, but I think it's pretty funny here in Miami, you know. So are all fruits the same? I'm sure everybody here has had a banana, right? Who's had a banana? Who's had a lime? Do they taste the same? No. One is sour, the other one is sweet. So are all fruits the same? No, they're all different. So why, when you hear reverse mortgage, would you think that the reverse mortgages are all the same? Who knows what fruit this is? No.
That's the jacket.
It's in Asia. It's big in Malaysia, Singapore. A durian. Durian. They have this putrid sewage-like smell to them. So, but supposedly they're delicious, and they're like a custard inside. And in Singapore, I went to Singapore and Malaysia a couple years ago. They joke and say Singapore's a fine city because they fine you for everything. You know, gum is illegal in Singapore because kids would take the gum and put it on the sensors of the train so they wouldn't close the door. So instead of making other rules, they just outlawed gum altogether. You can't buy it anywhere. And there's no durians allowed in public because it's so nasty and disgusting smell. So what I want you guys to get from this is, let's look deeper than the mass perception. The mass perception of a durian is this putrid smell. But when people really open it up only in their homes in Singapore and cook it and make pancakes and other things with it, it's really a delicious custard taste. So the fruit recap. Are all fruits sour? No. Are all fruits sweet? No. Does everyone know everything that there is about all fruits that exist? I think I proved that today because not anyone in here knew what a durian was. Does the initial perception of a fruit always mean that that perception is correct? When you smell that durian, it's nasty smelling, but it could be very nice and sweet tasting. So why the heck do so many people judge the HECM as if it's like every other reverse mortgage in history? So I'm going to go a little bit into the history of the reverse mortgage before we get into the nuts and bolts. So the first reverse mortgage was written here in the United States in 1961. It was not FHA insured, it was not the HECM or the HECM. Think about this, we still had segregation in 1961, so over the last 56 years our country has really changed and everything within our country has evolved as well. In 1988 the reverse mortgage was reintroduced as part of FHA under Ronald Reagan. It became insured by FHA, which is the Federal Housing Administration. At that point they changed the name to the home equity conversion mortgage. Now, whenever myself or any of my salespeople call somebody and they start talking about this program called the Home Equity Conversion Mortgage and it does this and that, at the end they say, oh, you're just talking about the reverse mortgage. Right, so just like tasting one fruit or the other, it's not all the same. So no longer a sour fruit, it's now sweeter. The negative things that you hear, they were true. It's not that the things you hear out there aren't true. It's that at one point they were true. They took away a lot of your equity, even on top of the interest. There were a lot of negative aspects to the reverse mortgage many years ago. The proprietary products don't exist anymore except for a jumbo. So 99% of reverse mortgages are FHA reverse. Now, recent history, I started in 2008, and in 2013 we had what's called the Reverse Mortgage Stabilization Act. They eliminated the reverse mortgage as it was, or the HECM as it was, and reintroduced it in a different way with more borrower protections. I'll show you a little bit about that later. It allows for people to hold their equity over time, because the point of this is not for you to pull all the money out and blow it. It's as a retirement planning tool. You use it as part of your retirement. Non-borrowing spouses. If there were two main things that we would hear negatively about the reverse mortgage in the media, one of them is foreclosing on someone who's not paying their taxes and insurance. The other one is foreclosing on, just use an example, the widow of a man who they did the reverse mortgage only under the husband's name. The husband was the borrower and the wife was the non-borrowing spouse. So before August of 2014, if the older borrower passed away and the non-borrowing spouse was still in the home, they had to kick her out or him out, because you had to pay off the debt. That's changed. We no longer do that. They're both protected. So financial assessment, I said the other negative thing was foreclosing on people who weren't paying their taxes and insurance. Now people have to qualify. The borrowers have to qualify with their income and their credit to make sure they can afford their tax and insurance payments. We want this to work for people. We don't want to put people, the 80-year-old widow, out on the street because she can't afford her taxes and insurance. High favorable rating for the HECM. Now, have you guys ever seen a president have a 95% approval rating? No, yet we elect these presidents with 50, 60% approval ratings. So for something that has such negative press over the last few years to go from 20, 30% negative press to now we only have 4.5% negative over this 2-month period, and we're talking 1,312 stories that came out throughout all of the media. Usually the negative ones are either opinion-based or based on misconceptions about how the program works. So it's really coming around and changing. What are some of the misconceptions, myths, and understanding? One of the big misconceptions is that you're going to lose your home. They're not going to kick anyone out of their home. If your house is free and clear, you owe nothing on your home. Realtors, if you don't pay your taxes, what happens? And your house is free and clear. Somebody buys a tax lien, and in 2 or 3 years, they're gonna go to auction. They're gonna win that house. So, if you don't pay your taxes and you have a mortgage on it, you're also gonna get foreclosed on. So the only way to lose your home is by not paying your taxes and insurance or not maintaining the property. So if a tree falls on your house after a hurricane and then you don't fix that, you're not maintaining your property, and they could call the loan due and payable. The bank will take our home. That falls into the same thing. That you're gonna get kicked out of your house. All of these are false as long as you do the following. If you pay your property taxes, if you pay your homeowner's insurance, if you maintain your property, and if you don't live to 150, because at 150 we will kick you out of the house. So I can't leave any money or equity to my kids is another misconception. That's not true. When we did the reverse mortgage for my grandparents at the peak of the market values in 2008, when they finally passed away and we sold the home, there was still $30,000 in equity that we realized from the sale. And that it cost too much. I have zero closing costs on some loans, not all. So how could it cost too much if there's no cost? I'm not saying this is the same case for everybody, but I'm just giving an example. Borrower eligibility. So this is not for anyone that's under 62, unless you're married to someone who's 62 and over. So you have to be 62 and over, at least one spouse, your primary residence. Condos are a pain. Sorry, no, you said you you perked up. You know FHA requirements for condos. It's very difficult. Our office will go through the approval process. We'll talk to the associations. We'll gather the paperwork. We'll send it into FHA. 90% of the time they don't take it because of whatever small rule. So primary residence is usually single family and townhouses. No second homes, no commercial properties, nothing like that. You must have 30 to 50% in equity based on your age. So if someone's 62, we can lend them 50% of the value. They're at the lowest age. If somebody's 90, we could lend them about 70% of the value. Those are approximations. We look at equity and credit, as I mentioned, and you must take a third-party counseling. So if you have a mortgage in here, did they make you go through a counseling before you got your mortgage? No. But imagine back to the real estate boom when we had all these predatory loans, we had the pick-up payments and the negative amortized loans that they start at 1%, but they didn't tell you that the next year it would be 7 just because they felt like increasing it, and people were going into foreclosure. If we had counseling back then, wouldn't we have been in a much better position? Because people would know what they're getting into. We have to do counseling with a reverse mortgage. No reverse mortgage company can start the process anywhere in the country without doing a counseling. And that's a third party. So show me the money. How can they realize the loan from the reverse mortgage? There's 3 different ways. You have a lump sum at closing. If they choose a fixed rate, you can only take a lump sum. So you can't have a line of credit with a fixed rate because it's an open-end loan. You pull money in and out. So to get the line of credit, you have to be on the adjustable rate. You could also do a lump sum on the adjustable rate. You can take monthly payments, 10-year versus term, which means sometimes they could take a monthly payment for the rest of their lives of, let's say, $1,000. Guaranteed for the rest of their lives till they're 150 years old. If they want it for a term of 15 years, maybe it's $1,500. If they want it for a shorter term of 10 years, maybe it's $2,000. All depends on the equity in their home. But you can use any combination of these. Maybe they want to take $50,000 at closing, leave a $50,000 line of credit, and get a $1,000 monthly payment. So we can do all these different things. Now remember what I said at the very beginning. They're pulling this money out and they're not taking money out of their pocket every month to make payments. People who are retired, people over 62, typically are on a fixed income. So this is huge. It helps them through retirement. Another aspect of the reverse mortgage, which most realtors don't even know exists, is the reverse mortgage for purchase. So if someone is 62 and they could borrow 50% from the home they already own, by the same token, if someone's 62 and they're going to buy a house, let's say they have $300,000 cash, and the realtors are showing them the $300,000 properties, but it's nothing that they really like. Well, they can turn around and they can buy a $400,000 property, put $200,000 down, and there will be $100,000 left over for retirement or anything like that, but they still have no mortgage payment. So instead of making that payment every month, the interest adds on. So with this, I would ask any realtors you know that would like me to educate them on how this works. That's part of what I do. The gray or silver divorce. This is a fairly new concept. Or actually, I shouldn't say it's a new concept. It's getting bigger. So divorce rates in the last 15 years have doubled for those who are 55 and over and tripled for those who are 65 and over. And tomorrow I'm presenting to the National Association of Divorce Professionals on just this subject. So in this case, one spouse, ex-spouse, can stay in the home and then pay off the other one, or they can take the money from their divorce and do the reverse purchase that we just mentioned. There's a lot of different options even for those people who are divorcing. And then imagine if they might get alimony payments in the beginning, but what if they stop? I have somebody that 6 years ago decided not to do the reverse mortgage, calls me now because the alimony payments stopped, so she has to do the reverse. Had she done it 6 years ago, she would have saved $2,000 a month on her mortgage payment, which totaled $152,000 that she would have had in the bank right now had she done the reverse mortgage 6 years ago. Okay? And that's the person I just talked about. So when I sit down with a client, this is really what everyone would see when I sit down with a client. We have the different interest rates. So here we have an annual adjusting. The interest rate is 4.4%. Monthly adjusting, 3.7. So this adjusts once a year. This adjusts once a month. So this one's fixed for a year. Starts a little bit higher. Has a lower cap, 9.4%. This one has a 13.7% cap. So these are the different adjustable rates. What's unique about the reverse mortgage is that it has a growth rate. The line of credit has a growth rate. No program has this at all. There's no mortgage that has this. So if you look up here, 5.7% is the growth rate. What that means is, let's say I can lend somebody $200,000 on their home. They take the lump sum of $200,000, the lump sum of $100,000, half of the $200 at closing. They leave the other $100,000 in the line of credit. So the $100,000 they've pulled out is used. That's going to accrue interest. They're going to have the 5.7% accruing on that. So in a year they'll owe $105,700. In 2 years, $111,000, right? By the same token, the money they have not drawn, the line of credit, is also going to grow at the same rate. So in 2 years they'll have a line of credit available of $111,000. This is, you can't find this anywhere. When I saw this, I was sold for my grandparents because we paid a lump sum and we took out the line of credit to pay their taxes and insurance over the years. So this is how it would work. In this case, closing costs are about $24,000. Remember, closing costs are too expensive. They used to be really high, but here we're able to give a credit. We're able to pay down $13,000 in the credit in the closing costs. So they could be much lower. The fixed rate is 5%, could be lower, closing costs are higher. Just want to give you guys an idea of what the borrowers would see, but don't take my word for it. So Wade Pfau, the PhD, also certified financial advisor. He teaches financial planners and financial advisors for their continuing education at the American College. He spoke to us at the NMLS convention, going back to the acronyms, a couple years ago, and said that he was in a room probably about this size with 50 financial planners. He was doing their CE for them. At the beginning he says, who here, by a show of hands, has a positive outlook on reverse mortgages? He said 3 or 4 halfway reluctantly raised their hands. Because the truth is, the education isn't out there. People don't understand how it truly works. By the end, he said to those same 50, who now has a positive response? And only 2 did not raise their hands. So just in a small class, he turned them around. One of the slides that stands out to me, because I can sit here for hours talking about all the other slides, is this. What he's saying is, let's say you have somebody who has $1 million in a portfolio. So somebody's managing $1 million. These people have succeeded their whole lives enough to save up $1 million in their portfolio. What are they getting from it? They're getting 4%. So that's $40,000 a year. You save $1 million, you're only getting $40,000 a year safely in retirement. Your home is worth $500,000 and it's paid off. So if this person that did a lot of saving through their lives for retirement ignores home equity, at 15 years, they'll still have about 100%, close to 100% chance of having money through retirement. But we're living longer, right? Someone starts retirement at 62, they might live till 92, 30 years from now with all the medical advancements. So 30 years from now, if they ignore their home equity, they only use their $1 million, the Monte Carlo scenarios, as they call it, say that they'll only have a 40% chance of having money. I don't know about you, but that doesn't sound very good to me, that there's a 40% chance I'll have money left over at the end of my retirement. So what these financial advisors are saying when they do these studies, and Wade Pfau's not the only one, this has been going on for years. Harold Evansky's another one who's big down here in South Florida. They're saying you must use any of these strategies. Texas Tech is the one that Harold Evansky did. Saks and Saks is another strategy. You must use these as part of your retirement plan. You can no longer ignore home equity. In all the further slides, he doesn't even use the ignore home equity because he says it's not an option. You have to consider the reverse mortgage as part of a retirement plan. So if you lose it, you use it as a last resort. FINRA, the Financial Industry Regulating Authority, used to say that it's a loan of last resort. They removed that a few years ago. So now financial advisors and financial planners can openly offer this to their clients. Especially now, I think today or tomorrow starts the fiduciary rule where they have to, for any financial planners in here, you have to show this to your borrowers, to your clients, our borrowers, because it is a viable option for them in retirement. These are all the other strategies that all the way through 40 years of retirement, they'll have over a 60 or 70% chance of having money if they're using the home equity in conjunction with their retirement plan. Now, we all know that it's a very small percentage of our society that have $1 million set aside for retirement. So if it could work for them, can't it work for people that don't? That have a $100,000 IRA or have no IRA, and you have Social Security, maybe you have a pension, you have to consider your home equity as part of your retirement plan. This goes more into the different numbers. I'd rather answer some questions. Here's an amortization schedule. So I was telling you, just illustrating with my hands, the 100,000, the interest that grows, and then the line of credit that grows. So in this case, we have up there, it says expected appreciation. That's the appreciation of the home. So starting here with property value at 4%, of property value of 400,000, appreciating at 4% a year, a national average historically. So the values are increasing. The initial line of credit, we start in the line of credit at 221 in this case. If they don't touch the line of credit, they're 69 right now, they turn 70 in 1 year. In 1 year, the 221,000 line of credit is going to be 234,000. In 4 years, the line of credit will be 294. So let's say they have that $1 million and they're using their retirement funds, but they take this line of credit out and they don't touch it. All of a sudden, health issues come up, whatever might happen. They have this line of credit that's growing in their favor. In 4 years is 294, 10 years is 392. The value is also increasing, so they're not losing money, they're not losing equity, they're just able to borrow more in the future if they need it. Nothing has this growth of line of credit, nothing out there. And a lot of these financial planners, they start looking at this because of that. They want to look at, there's actually a point where the line of credit can surpass the value. They just pull all the money out. So I didn't mention an aspect of that. Let's say somebody owes $500,000 when they pass away, but the value is only $400,000. The borrowers don't have to pay any of that. FHA's MIP, mortgage insurance premium, or mortgage insurance policy, steps in and pays that difference. They pay that loss. So they never lose, the heirs never lose. A big question that I get all the time, of course, is what happens at the end. So somebody's borrowed all this money. Someone borrowed, let's say they pull all the money out and they owe $400,000 and the value is $592. They pass away, the heirs inherit the property. The heirs have up to a year to somehow sell or refinance the property. So once they sell, the profits are theirs, the equity is still theirs. If they refinance and keep it and rent it out or live in it, they can live in it without any problems. They don't lose the home. So what is your house doing for you? What's your referrals house doing for you? A lot of us should know, Talia might not because I know she's pretty young, of the Money Pit. Okay. Of the Money Pit. This movie's a classic. This movie's hilarious. Tom Hanks in the beginning. You know, we all put a lot of money into our houses. You do additions, you remodel it, you maintenance, principal and interest, the taxes and insurance you pay all these years. It is really a money pit. It sucks up a lot of our money. So what are you going to do? You're retired and you're sitting on this house that's paid off. The only viable option to tapping back into that money is through the reverse mortgage. So thank you for giving me the opportunity to speak to you all, and I'll open it up to questions now.